Hello and welcome to Options in Plain English. Today we're going to be talking about what the terms at the money, out of the money, and in the money mean. When talking about different options and their strike prices, it's always important to compare the strike price of either the call or the put that we're looking at and see where it stands and where it is as it relates to the current price of the underlying. This is important because traders usually talk about options in a way that it's easy to refer to them, and sometimes they'll refer to an option as being in the money, at the money, or out of the money. So we want to understand what those terms mean, and especially how we can identify them and how they differ between calls and puts. So basically, what it's very simple to understand. So if we have the current price of the underlying and we're looking at calls, the strike price that is the closest to the current price is going to be called the at the money strike. So for example, if there's a stock that's trading at $70, then the $70 strike is going to be the at the money strike for both calls and puts. Of course, sometimes in this example, the $70 strike is not going to be available, for example, or if the price is $69.50, for example, and there is no $69.50 strike, then of course we would go to the strike that is the closest to the current price, and that's going to be called the at the money strike. It doesn't need to be exact, but it does need to be the one that is the closest or the one that is around the closest to the current price. So for example, if there is a price that's $61 and there is a $60 strike and there is also a $62 strike, then either one of those two, or actually both of them, could be considered at the money. Now, for out of the money options in general are the ones where their strike price would have no value if we were to exercise them today. So they are in relation to the current price. For calls, they would be higher than the current price, and for puts, they would be lower than the current at the money. So for example, if we had an example for calls and we wanted to be looking at at a price of $20, for example, starting on the $20, $21 strike, 22, 23, 24, etc., those calls would be out of the money. And they would be out of the money because if we were to exercise them, they would have no value. So their value is only based on the possibility that that the current price could in the future, and it depends on how long we still have until expiration, but it depends on the possibility and on the probability that the current price is going to make those options worth something. So basically, they depend on the price moving in that direction in the time that we have remaining until expiration. So in the case of calls, we'd be talking about the prices, the strike prices that are higher than the current price, and in the case of puts, it would be the strike prices that are lower than the current price. So if the at the money, for example, is 20 right now, and then the $18 put and the $16 put would be considered out of the money. The opposite is in the money. So for calls, an in the money call would be a call where the strike price is lower than the at the money, so lower than the current price, so that it holds at least some value. So for example, if we have the $20 strike as our current price or as our at the money, then for example, the $18 call would already have some value because you could exercise the $18 strike, the $18 strike call, and then get the stock for $18 and then sell it out at the current price of $20. So it has already in it embedded the difference between the strike price and the current price. And because of this, they're considered in the money because they're already inside a range where they have some value. And the same thing applies to puts, but it works to the other side. So basically, puts that have a strike price that is higher than the at the money or higher than the current price of the underlying would be considered in the money. So same example, if we have an underlying that's currently trading at $20, the 22, the 24, the $26 strike are going to be considered in the money. Now, why is this important? As I was mentioning before, traders like to use shorthands and to refer to options in a very quick and understandable way. So a trader or an investor, or if you want to talk about your strategy with someone else, they might be they might be quickly referring to a certain strategy, and they would be referring to buying a certain call that's out of the money, or buying an at the money put, or selling an at the money call. And that way they don't need to tell you, oh, we are talking about so and so stock that's currently trading at $18. And what I mean is any call that is higher, whose strike price is higher than that. Because of this, they'll just use the terms at the money, in the money, and out of the money. Also, it's important to know that in practical terms, although a lot of people like to use in the money options, so in the money calls and in the money puts, most of the options that are traded, so most of the volume, if you look at the liquidity in the options market, most of the liquidity is centered around the at the money and the out of the money options, both for calls and puts. Again, the in the money options are also used and people trade them, especially because an option that starts at the money could become later in the money. So you end up with an in the money option, even though you didn't actually want to have an in the money option, but it ends up being that way. But if you want to talk about liquidity, for liquidity purposes, we could be talking about the most of the liquidity centered around the at the monies and the out of the money for both puts and calls. Now let's look at an example here with real prices and see let's start identifying what the out of the money, at the money, and in the money options would be. So let's say, for example, that we have a stock whose current price is $100. So any strike that is at $100, or if it didn't exist, anything that's the closest to $100 would be called the at the money strikes for both calls and puts. Now for calls, if we have strike prices of 105, 110, those would be, and further, those would be considered out of the money calls. So 105, 110, 115, and so on and so forth. Anything that's higher than the current price is an out of the money. Now, if we start looking at prices below 90, 80, 70, etc., those will be called in the money calls, because those, for example, the $80 strike call already has $20 of actual value, and that's what makes this particular call an in the money call. It's already inside the range where it has some value. Now for puts, if we start analyzing and we start with prices that are lower, the $90 strike, the $80 strike, those will be considered out of the money puts. Those options don't have any actual value. If you were to exercise them, they wouldn't have any value, but they do have a price and premium in the market because they're based on what could happen if the price of the underlying started declining. So it's based purely on probabilities and purely on the possibility that they might appreciate in the future. Now, if we look at the 105, 110, and anything higher than 100, those would be called in the money puts because they already have some value. So the 110, for example, already has $10 of actual value. So it will be trading in the market for at least $10. And if there's a long time remaining, then they'll probably be trading for considerably more. So maybe $16, $17, but at least $10. Now, traders sometimes also like to refer to certain strikes that are very far away from the current price as the deep options. So you could have, for example, for calls, the $150 strike call when the current price is 100 would be considered not only an out of the money call, but a deep out of the money call. Likewise, if we're talking about calls and in the money calls, if there's a strike price that's far away from the current price, traders would refer to them as deep in the money calls. So deep out of the money options usually have very little value. Why? Because by being out of the money, they don't have any actual value, any intrinsic value, as we'll see later on that this portion of the option price is called. But also because they're deep, the probability that it would become at the money or in the money are low, and that's why they're trading for very little in the market. For puts, is the same thing. Strike price that is far from at the money on the downside, for example, $50 would be considered a deep out of the money put, and a $150 strike price for a put would be considered a deep in the money put. And also keep in mind the $150 strike put would have at least $50 of value. So you'll be trading at least $50 and then some extra portion of value that could be related to the probability and possibility that it could continue to go down. So maybe the $150 strike put is going to be trading at, let's say, $55. So $50 of actual value and then $5 to account for the fact that it could continue to go down and we have some time remaining until the option expires. Now let's take a look at our trading platform and look at the distinction between at the money, out of the money, and in the money options in the platform. And now we're here on the trading platform. We're going to be analyzing the QQQ, which is an ETF, an exchange traded fund for the NASDAQ 100. Sometimes it's called the Cubes, and it's a very widely used ETF. So it has a lot of liquidity, and it's probably one that you're going to be very familiar with if you start trading options. Now this one is trading at, it closed at $200.86, but in after hours it went to $201.37 to $201.55. So it's in between $200.86 and $201.55. So the price, let's say that it's $201. So the $201 strike, in this case we're analyzing the expiration for June of 2020. So there's as of this recording 68 days to go. So the 201 strike call on the left hand side and the 201 strike put on the right hand side, those would be considered the at the money options, the at the money calls and the at the money puts. From that point and lower in strike price, which is laid out in a somewhat baffling way it's laid out the other way around. So basically anything from this point and higher, which is lower in price, these would be the out of the money puts, and anything above 201 would be considered the in the money puts. Likewise, if we go to the 201 call, anything above the 201 would be considered an out of the money call, and anything below 201 in price, which is in this arrangement, it's anything from this point and higher, would be considered an in the money call. Now, one of the ways that we can make sure that we are talking about out of the money calls is I pulled up the intrinsic value of the option in this column, so you can see that this is the actual value that you would get if you were to exercise those calls and puts. So you can see that this column, anything that's above 201 for calls has a value of 0. Likewise, for puts, anything that's anything less than 201, it also has an intrinsic value of 0. So this is how we know that those are out of the money puts and out of the money calls. Now you can see that also visually. If you look at your platform, and your platform, if it's not Thinkorswim, this is Thinkorswim. If it's not Thinkorswim, maybe it's going to be shown in a different way. But for the most part, you can see that they're shaded in different color. This is because, like I was saying, most of the volume is concentrated on the out of the money calls and out of the money puts. The in the monies are usually not used a lot, but keep in mind, sometimes an option could start when it was initially put on, it could start out as an out of the money option, and then because of price movement, it could end up being an in the money call or put. So this is basically what's important. Also, something else. I'm only showing here 20 strikes, but there's plenty more. So I'm going to show all of them, and I'm going to go back to the at the money. This is the at the money. So these are the ones that are out of the money, puts in this case. If we go really far, and these ones still have a bid and an ask, so they still have some value. These ones would be called deep out of the money puts. These ones would be called deep in the money puts. These ones would be deep out of the money calls, and these ones would be called deep in the money calls. And you can see that they, of course, the in the money have a lot of value. See, for example, this $85 call has a value of $115 to $116. Why? Because it's trading at 200, so it has to have at least $115 in value, because that's how much you would get if you were to exercise it now. And on top of that, it needs to have an additional portion to account for the possibility that it might be giving you more profit. So that has a price in the market as well. So this is basically what's important about in the money, at the money, and out of the money options. Now we can start referring to them as being at the money, in the money, and out of the money, and you'll know what we're talking about. Later on, we're going to talk about intrinsic and extrinsic value, and that's going to be very important for you to understand how options are priced, and we're going to have a lesson detailing this in the near future. Thank you very much, and hope to see you around next time. Goodbye.